Hello guys, I'm Clara.
I'm Valen. I'm Grace.
I'm Yumiko.
And today we're gonna talk about long-term debt, private stock, and common stock. So let's jump to our video. Bond is a long-term debt instrument with a final maturity generally being 10 years or more. The basic terms of bond include par value, maturity, coupon rate, and bond ratings.
Trustee is a person or institution designated by a bond issuer as the official representative of the bondholders. Typically, a bank serves as trustee, while indenture is the legal agreement, also called the deed of trust, between the corporation issuing bonds and the bondholders, establishing the terms of the bond issue and naming the trustee.
The first one is debenture, which is a long-term and unsecured debt instrument. Investors look to the earning power of the firm as their primary security. Investors receive some protection by the restriction imposed in the bond indenture, particularly any negative pledge clause. A negative pledge clause precludes the corporation from pledging any of its assets not already pledged to other creditors.
The second is a subordinate debenture, which is a long-term unsecured debt instrument with a lower claim on assets and income than other classes of debt, namely known as junior debt. In this case, subordinate debenture holders rank behind debenture holders but ahead of preferred and common stockholders in the event of liquidation. Frequently, the security of convertible into common stock to lower the yield required by subordinated debenture holders, often less than regular debentures.
The third one is income bond, where the payment of interest is contingent upon sufficient earnings of the firm. Frequently, there is a cumulative feature also in these bonds. Frequently, there is a cumulative feature which provides that any unpaid interest in a particular year accumulates. The cumulative obligation is usually limited to no more than 2 years. The bonds are unpopular with investors, usually limited to record organization, but are still senior to preferred and common shareholders in the event of liquidation.
The third one is junk bond, which is a high-risk and high-yield bond, often called as unsecured bond rate below investment grade. These are bonds with a rating of BA or Moody's or lower. Principal investors are pension funds, high-yield bond, mutual funds, and some individual investors. Liquidity varies depending on investor sentiments, and junk bonds were used frequently in the 1980s and as a means of financing leveraged buyouts.
The fifth one is a mortgage bond, which is a bond that issued secured by a mortgage on the issuer's property. The last one is equipment trust certificates that is held by the trustee, and the trustee leases the equipment to the railroad.
Next, what is asset securitization? It is a process of packaging a pool of assets and then selling interest in the pool in the form of asset-backed securities. Asset-backed securities is a debt securities whose interest and principal payments are provided by the cash flows coming from a discrete pool of assets.
So, what is the purpose of securing the asset? It is to reduce financing costs. Sinking fund is a fund that established to periodically retire a portion of a security issue before maturity. The corporation is required to make periodic sinking fund payments to a trustee. There are two forms for the sinking fund requirement of a bond. The first one is the corporation makes a cash payment to the trustee, which calls the bond. The second one, the corporation purchases bonds in the open market and delivers them to the trustee.
When bonds are called for redemption, the bondholder will receive a sinking fund call price. The bonds are called on a lottery basis by their serial numbers and published in the periodicals like the Wall Street Journal. Bonds also should be purchased in the open market if the market price is less than the sinking fund call price. Volatility in interest rates or a decline in the credit quality of the firm could lower the market price of the bond and enhance the value of the firm of having this option. Bondholders may benefit from the orderly retirement of debt amortization effect, which reduces the default risk of the firm and adds liquidity to bonds outstanding.
balloon payment is a payment on debt that is much larger than others' payment. Serial bonds is an issue of bonds with different maturities as distinguished from an issue where all bonds have identical maturities or term bonds. Call provision, it is a feature in an indenture that permits the issuer to repurchase securities at fixed asset or a series of fixed assets before maturity, also called call feature. Not all bonds are callable. In periods of low interest, hence low coupon rates, firms are more likely to issue non-callable bonds.
When a bond is callable, the call price is usually above the par value of the bond and often decreases over time. Call price, the price at which a security with a call provision can be purchased by the issuer prior to the security's maturity. For example, the call price for the first year might equal the bond par value plus 1 year's interest. According to when they can be exercised, call provisions can be either immediate or deferred. The call provisions provides financing flexibility for the firm as conditions change.
Preferred stock is a type of stock that promises a fixed dividend, but at the discretion of the board of directors. The basic terms of preferred stock includes par value, dividend rate, and maturity. There are cumulative dividends. Feature is a requirement that all cumulative unpaid dividends on the preferred stock be paid before a dividend may be paid on the common stock.
How about the voting rights in special situations? Preferred stockholders are not normally given a voice in management unless the company is unable to pay preferred stock dividend during a specific period. If such a situation presents itself, the class of preferred stockholders would be entitled to elect a specified number of directors. Any situation in which the company defaults under restriction in the agreement may lead to voting power for preferred shareholders. Preferred shareholders cannot force the immediate repayment of obligations, like debt obligations.
Retirement of preferred stock. Call provision. Almost all issues carry a call provision because of the infinite maturity. It is often a cheaper method of retirement than open market purchases, dividing tenders, or an exchange of securities. Sinking funds like bonds, many preferred issues provide for this method of retirement. Conversion. Certain issues are convertible into common stock at the option of the preferred stockholder.
Common stock is a securities that represent the ultimate ownership and risk position in a corporation. The basic term of common stock includes authorized shares, issued shares, and outstanding shares. There are 4 types of common stock value. The first one is par value or the face value. Stock should never be issued below par value as shareholders would be legally liable for any discount from par if the firm is liquidated. The second one is common stock that is authorized without par value or no par stock is carried on the books at the original market price or at some assigned or stated value. The difference between the issuing price and the par or stated value is additional paid in capital.
Second one is book value. Shareholders' equity as listed on the balance sheet divided by the number of shares outstanding. The third one is liquidating value. The value per share if the firm assets are sold separately from the operating organization. This value may be less or greater than book value. Rarely are two values identical.
Market value, the current price at which the stock is currently trading. This value is usually greater than book value per share, but can occasionally be less than book value per share for firms that have been are expected to be in financial difficulties. Rarely are the two values identical. Market value per share may be difficult to obtain from thinly traded securities. Typically, the shares of new companies are traded in the over-the-counter OTC market, where dealers maintain an inventory of the stock to provide additional liquidity.
Rights of common shareholders. First one is right to income, entitled to share in the company earnings of the company only if cash dividends are paid via approval by the board of directors. Second one is right to purchase new shares. The corporate charter of state statute may provide current shareholders with a preemptive right, which requires that the shareholders be first offered any new issue of common stock or an issue that can be converted into common stock. And last one is voting rights. Because the shareholders are owners of the firm, they are entitled to elect the board of directors.
There are two methods of voting. The first one in person or by proxy. What is proxy? It is a legal document giving one person authority to act for another.
Proxy contest. It occurs usually when disagreement between management and outside or minority party. Non-management group will register its proxy statement with the SEC and will often send an alternative proxy request to the shareholders. Management, due to corporate resources and organization, is generally favored to win. E-proxies are expected to provide a more cost-effective mechanism for non-management groups to communicate with shareholders and possibly reduce the management and fund pressure.
Voting procedures. The board of directors are elected under either plurality voting, a method of electing corporate directors where each common share held carries one vote for each director position that is open. The highest vote count wins the open director position. Doesn't contain withheld or against votes. Cumulative voting, a method of electing corporate directors where each common share held carries as many votes as there are directors to be elected, and each shareholder may accumulate these votes and cast them in any fashion for one or more particular directors.
Dual class common stock. Two classes of common stock usually designated Class A and Class B. Class A is usually for the weaker voting or non-voting class, and Class B is usually the stronger. This is used to retain control for founders, management, or some other specific group. So what is the differences between common stock and preferred stock? The first one is company ownership. Holders of both common stock and preferred stock own a stake in a company. The second one, voting rights. Even though both common shareholders and preferred shareholders own a part of the company, only the common shareholders have voting rights. Preferred shareholders do not have voting rights. For example, if there were a vote on the new board of directors, common shareholders would have a say, whereas preferred shareholders will not be able to vote. The third one is dividend. Although both shareholders can receive dividends, the payment of dividends differs in nature. For common shares, the dividends are variable and are paid out depending on how profitable the company is.
The fourth one is claim to earnings. When a company reports earnings, there is an order when investors are paid out. Usually, bondholders are paid out first and common shareholders are paid out last. Because preferred shares are a combination of both bonds and common shares. Preferred shareholders are paid out after the bond of shareholders but before the common stockholders. In the event that the company goes bankrupt, the preferred shareholders need to be paid first before common stockholders get anything. And the fifth one is conversion. Preferred shares can also be converted to a fixed number of common shares, but common shares cannot be converted to preferred shares.
And the last one is returns. Ultimately, both common and preferred shares are paid out of a company earnings. The returns of a common share are most commonly based on the increase or decrease of the share price, including an optional dividend paid out. In contrast, the returns on preferred shares are mainly based on its mandatory dividends.
Common shares and preferred shares as an investment. In terms of availability, common shares are a lot more available than preferred shares. Whether or not to buy common shares and preferred shares ultimately comes down to the investor's goals. Those who buy common shares are usually interested in the potential for higher profits, but with higher risk. In comparison, those who buy preferred shares are usually interested in the regular dividend income with lower risk. Also, preferred stock may not be chosen by investors in an environment with rising interest rate, which lower the par value of the shares.
So that's all about our video. We hope that you guys can learn about long-term debt, preferred stock, and common stock. Bye bye.